This conference will now be recorded.
Okay, perfect. So again, thank you everybody for joining us. Jason, thank you so much for being here. We've got a lot of information to cover, so let's not delay and let's get started. Jason, why don't you start by telling me a little bit about who you are and how long you've been with NASB?
Yeah, definitely. My name is Jason Zook, and I'm here with North American Savings Bank. We're out of Kansas City, Missouri, and the bank's been around since 1927, and I've been here since 2004. We started the first national non-recourse loan program, kind of worked it through, wrote the book on it, and so I've been doing it for a really long time, and can answer pretty much any question that you have about non-recourse loans. Now, for the audience, do some people already have self-directed IRAs, or do we need to talk about those as well?
We're going to go through from bare basics all the way through advanced questions for those that ask in on the chat window. Many of these clients do already have 1031 exchanges that they've used in their IRAs. They've done direct IRA purchases, but we've also got some beginners on here that own some traditional real estate with Fannie Mae and similar type loan programs, but have never used their IRA leveraged. So let's start with the bare basics of what IRA lending is and what the advantages of that are.
Definitely. Well, if you do have an IRA and you roll it over into a self-directed IRA, IRA LLC, self-directed, any type of self-directed account, we can lend non-recourse to that. So if the advantages of using debt to buy the IRA, what we're going to look at today is the advantages of using debt in the IRA, how you can get a non-recourse loan to buy real estate in the IRA, and then the guidelines and parameters for our bank to include loan terms such as the interest rates for non-recourse, the cost involved, loan to values, the types of property that we approve, and how we determine eligibility. For a non-recourse loan, we're not looking at the borrower to qualify, so we're looking at things like property type, size, cash flow, curb appeal, instead of a borrower's income, assets, or employment.
So in terms of the documentation requirements, because that's a question that I get a lot with our portfolio and Fannie Mae products, what type of personal information are you going to be requesting from clients that come to you to pre-qualify or qualify for one of these purchases?
We're not looking at their income, their assets, or employment. We're looking specifically at the property to qualify. Now, we do pull credit, but it's also to look at things like, are there any liens on that report that could affect, our taking back the property if we had to, for instance, or is there a big history of mortgage lates or bankruptcies or foreclosures? If there are, we can get by those as long as the bank is comfortable with the property equity position that we have.
So are you requesting tax returns, bank statements, all those types of things from borrowers?
None of that. Very document friendly. We don't need any of that. No income, no assets, no employment, no tax returns. You bring us a property within a couple of hours, we can tell you exactly what we can lend, what the loan terms are, and we'll just need a couple of items from you. We don't need to look at all the other personal information.
So for the clients that have traditionally been just letting the IRA sit there and grow with whatever investments are happening with that, what my recommendation is, of course, is looking at buying real estate in any avenue, but certainly the leverage ability with using your lending programs for the IRA. So if you were to pay cash for a property from your IRA, so say that you wanted to do a self-directed and you went and bought a $150,000 home, you've got one $150,000 property cash flowing, you've got one $150,000 property appreciating, you've got one $150,000. So all your eggs are in one basket. Now, if someone were to bring that same $150,000 over to you, and let's use the new construction example because that's the majority of what you and I do together, what type of difference are they going to see with that same amount of money using your leveraging as opposed to just paying cash? How many properties, and just using ballpark numbers at $150,000 a piece, would they be able to get with financing versus with traditional cash purchase?
Yeah, and then for a $150,000 property, is that correct?
Mm-hmm.
Yeah, for a $150,000 property, new construction, we can lend at least 60% of the purchase price, and many times 65 to 70% of the purchase price. So your down payment is anywhere from $45,000 to $60,000 depending on the property information. So you can see that that'll give you at least two properties instead of the one. And if you have other retirement funds beyond, let's say, even in a work 401k or somewhere else, we can show your reserves there, even though you can't bring it over. So that'll really allow you to maximize the self-directed IRA. More money you have, obviously, the more properties that you can get. So it's anywhere from 45 to 60 down on a $150,000 property. Where if you're using it all in one basket there, you're stuck with the one.
Fantastic. And the other thing that I love about using this type of lending with the IRA is, some people don't have enough to buy a property in their IRA. And so by doing this, you can use your 40, your 50, your $60,000 to buy a property, whereas otherwise you wouldn't be able to do that, because we all know in this market, and certainly in North Texas, we're not going to find good, worthwhile properties for that price point. Now, for those clients that only currently just have a regular IRA, a regular 401k, they don't have it self-directed, they don't have any of that, and they don't really know what that means. Can you go over what that process looks like and where they get started?
Yeah, for a self-directed IRA retirement account, there are multiple companies out there. There's dozens of them. You can use a custodian or administrator, which is a company that will actually hold your funds. And from there, anytime you want to purchase property, you'll just fill out paperwork with them, and they'll then send your money in. So you'll roll your money with them. When you want to buy something, you fill out the paperwork, and then they send your money to purchase the property. There's also IRA LLCs where you have a little more control that way. It costs a little more upfront to do, but if you have an IRA LLC, then you can be the LLC manager. You can actually write checks yourself, gives you a little bit more checkbook control that way. So instead of filling out paperwork and paying another company to do it, you just pay a more hefty fee up front, and you're the manager and get to make those decisions. So whether you use a self-directed IRA or a self-directed IRA LLC, they're both pretty easy to set up and take just a couple of weeks and very minimal fees to get started. On our website, which is iralending.com, we do have links to all the companies out there that we're aware of. We have them classified under custodians and administrators, IRA LLC facilitators, and now there's also self-directed 401k facilitators. I'd encourage you to definitely do some research on that, or let us know and we can try to point you in the right direction to do that. Once you have that set up within that couple of weeks, then you can go out and start looking at property and really get ready to purchase something.
Now, for the clients that have a lot of money in their IRAs, so hundreds and hundreds of thousands of dollars, let's say, does your bank have a maximum number of properties they're willing to lend to any specific client? Is there different guidelines that change if they buy more than one, or if they buy 10 or 20? How does that work?
Yeah, the most I've seen us do with one client is 9, and that's because the client stopped at 9 properties. We don't have any guidelines that prohibit us from lending multiple times, even 10 properties or 10 loans. We may base it more up on area. So if a client's buying more in a rural area, we may only want a couple in one certain area, or if it's in one apartment complex, maybe we only do 3 or 4 in that complex, but we don't limit it to the buyer, as long as they have the money to continue on and the reserves to show that they can support the properties, then we're comfortable with as many as they'd like.
Now, with it being non-recourse, for some of our clients that may not know what that means, what is the difference with that and, say, a traditional Fannie Mae mortgage if you were to buy just with cash in your bank account?
Right. On a non-recourse loan, the only recourse is the property itself. So there is no recourse against the IRA. There is no recourse against the borrower. There's no credit score impact. So in the event that your IRA stops making payments on the property, we can take the property back, but it still has no impact against your credit score. We can't come back after your IRA. It's only the property itself. And so that's why it's a document-friendly loan, where we don't really care about your income, assets, or employment, because we can't come back after you.
Excellent. Okay. And that's something that's very different, because your traditional financing avenues, even for those that go into portfolio and LLC lending, you really have to be extremely well qualified and someone who's been doing this a long time and has significant assets for it to be a non-recourse loan. And so this is one of the few loan types where no matter what, it is a non-recourse loan. So any questions, make sure that you're doing that chat window. That way you have that information. And let's talk about some of the other advantages and how really the process works. So if someone has a self-directed IRA, or they have this LLC created, they buy a property, every month rent comes into us. And then those payments are being sent to, if you're using a custodian, the custodian, or if you're handling it yourself, it's going to the LLC's account. So in reality, this isn't money that you're going to be able to use and spend. It's money that's going to go back in to build your IRA. going to allow you to have larger gains and potential realization of the growth that all of these markets are having right now, because of course we want to spread out as many properties as we can so that we have the maximum potential for that return. That allows you to diversify those assets or be able to acquire an asset, as I mentioned, otherwise if you didn't have enough money now being saved. So let's talk about some of the kind of just eligibility requirements. There really aren't any. The only real requirement is the property has to qualify for your terms and they have to have the cash to do that, correct?
That is correct. Yeah. For us, we're not looking at a whole lot of speculative markets, but more, properties expected cash flow. So, we can take a look at any of the markets that OmniKey has. Typically, we want 30 to 40% down. Now, 40% is more typical, except on newer property. And a lot of times with OmniKey, we're dealing with more newer homes and newer construction. So there is much more opportunity to go less than 40% down there. Texas also, we do more loans in Texas than any other state. Even though we're out of Kansas City, Missouri, we have more clients out of Texas than anywhere else. Management loves Texas. There's a lot of good metropolitan areas that we love lending in. Now, we do require 40% down typically if it is a multifamily or attached type home, so a condo, a townhome, or multi-units. However, if it's new construction in Texas, I'm sure we'd consider even going above 60% just because of that in itself.
Absolutely.
And we can go up to 8 units. If you're looking at greater than 8 units, that is for our commercial side, but we can get you a special quote there as well.
Now, there are some contract things that have to be done on our end, and it's a little bit different than how your traditional purchase works. So can you go over a little bit of the logistics of how the contract process works for those that are looking to do this type of leveraging?
Definitely. If you use a self-directed IRA account, then the contract will be in the name of the purchaser, and the purchaser will be the custodian's name, and then FBO, which stands for benefit of, and then your name, IRA. So whichever custodian that you choose, we'll be able to tell you exactly how to do the purchaser name. But in the event that the contract is wrong up front, no worries. We can usually just get a contract amendment at some time during the loan process. We'd like to get it right up front for everybody, but if we have to get an amendment, we can just have somebody draw it up very quickly, and at closing, everybody can sign it. Now, if you're using an LLC, now it will just be titled in the LLC's name, and you as the manager will just sign all the documents yourself instead of the custodian executing everything. You can also partner with other individuals or other IRAs, and then it would say the IRA company for benefit of your name IRA and undivided 50% or whatever percentage of ownership that you do have. But just so you know, so if you wanted to partner with a friend or a spouse or a kid or something, you could do that, and we would help you with that contract information as well.
So we've got our first question, and this is, would NASB lend to U.S. citizens living abroad who have self-directed IRAs? And would you still offer that at the 60 to 70% leverage?
We would, yeah, as long as it's the property is based in the United States and it's a self-directed retirement account that is United States based. That is no problem at all. Even if you're overseas, you can still have all the same benefits of the property here.
And generally, once you all have a property ready to go, construction's complete, or we're at that point, or if it's a pre-owned home, typically we're looking about a month to close. Is that correct?
That's exactly right. Yeah, with a new construction property, we usually like to get started a couple months before just to make sure that we're ready. The moment the builder's done, they want their money. So we want to make sure that we're ready. We'll start a couple of months before that, send an appraiser in for a final inspection right when it's completed so that we can fund immediately. But other than that, normally it's about 30 days. If it's an LLC, sometimes maybe a little less because you can table fund, where when it's in the self-directed custodian, you'll sign as read and approved, and then the documents have to go to them for execution. So there might be a couple day lag time there between the signing and the funding when you use the custodian or administrative account.
Now, one of the biggest questions I get these days is, how do you still have cash flow with the market being so hot? And one of the ways that we look at cash flow and the way that works is looking at the amortization and the interest rate. And the amortization, for anyone who doesn't know, essentially means how long or what period of time are you paying off that loan over. So the longer the amortization, the lower the principal payment every month. So typically, what are your amortizations for your loans, and specifically, what are the amortizations for new construction or newer construction type products?
Definitely. The longest amortization product that we offer for a fixed loan is 20 years. So if you really think you're going to keep the loan and or the property 20 years, and you want that comfortability of a long fixed loan, you can go out up to 20 years. We do have some ARM products though, the 5 and the 10-year ARM, where it's fixed for 5 years or 10 years and then adjust after that. And on those, we can get out 25 years. What that does is that gives you, a little bit lower interest rate because you're using the ARMs, and also a lower payment amount because you're going over a longer period of time of that 25 years. So really what I tell my clients is I try to get a sense from them how long they want to keep the loan. And if they're only keeping it, say, 6 to 8 years, the 5-year ARM is the way to go. Pay a little less interest rate over a longer period of time and make less payments. But if you really think you're going to be in for the long haul on the loan and the property, then even though you'll pay a little more monthly, that peace of mind of having a 20-year fix is more sellable to some.
Absolutely. So all of my clients that work with us regularly know my opinion on this, that we typically are selling properties within 5 to 6 years at most. So I'm a big believer in the ARM. The biggest thing is the amortization. So I typically, if I can get a better deal and only lock the rate for up to 10 years, the worst thing that happens is you refinance or you sell the property. And so it's one of those things that I'm a big believer in, getting the best interest rate with the longest amortization you can. Now, a couple other questions before we move on to refinancing. Do you require escrows for taxes and insurance, or is that something that the client will be paying directly?
We do. That is a requirement where we will escrow and impound for the taxes and insurance. So at closing, the year premium will be paid, and then from there, we'll escrow for that.
Now, what about prepayment penalties? If someone purchases one of these loans and then decides to sell the property in 2 years, is there a prepayment penalty?
There is not. You could pay any amount of principal above and beyond that you'd like each month, and you could sell the property whenever you'd like without penalty as well.
Okay. And then the biggest question, what are your interest rates? What type of rates are we seeing for these products, and how does that differ from both pre-owned and new construction?
Definitely. Now, on the conventional side, the rates can move every day. For these, we've only had one rate change in almost 3 years. This is a commercial loan. It's considered commercial because we're lending to an entity and we're not qualifying you as an individual. So the interest rates are a little bit higher than what you'll find the conventional side. They start in the mid fives. The lowest rate possible is 5.625. The highest is 6 1/4, and there are multiple loan products in between there. So, when you're putting down 30 and 40%, that mitigates how much that loan amount that you have to take with a little bit higher rates. But, our job is to show you as many scenarios as you'd like to see, so you can see what the cash flow will look like and what your payment and cost will be. But I don't expect movement anytime soon, really, in the interest rates.
Absolutely. So for some of our clients that have already leveraged their IRA to purchase property and they've paid cash for that property, or perhaps they have a property they currently have a non-recourse loan on, or they have a loan on and they're looking for better terms, or the value's gone up and they're looking to cash out, what type of opportunities do you have for those clients?
Yeah, and I get that question all the time. I have clients come to us who have been put in a hard money loan where they're paying 8 and 10% for this property and didn't realize there was a federal bank out there that could offer them better terms. So for us, on a property that you've already owned, we can offer a cash out. We'll look at what you paid for the property. If there's some renovations that were put into it, we can also look at what the value is today. So some people will buy a property just because due to time constraints, they had to hurry and get the property to get a good deal, or they didn't know about us. But regardless of the reasons why, we can take a look at the property and within a couple of hours give you an idea of what we can lend and what the exact terms would be. And then the money would just be deposited back into your retirement account, and you could do whatever you'd like with that. We don't get involved with what you're going to do with the money once you have it.
Fantastic. And as a reminder, any questions, let me know. We can certainly answer any before we finish up here. And so, Jason, what else have I not asked, and what else have we not covered that you think our clients want to know?
Yeah, definitely. With newer property, we don't have to worry about a whole lot. If we're using older property or renovated property, then the way we look at it can change. But for us, as long as it's nothing too crazy unique, we're looking at just cookie cutter property where if we had to take it back, could we get rid of it quickly? That's really what the bank's looking at. So the newer, the better, the less unique, the better for us. But single family homes, townhomes, condos, multi-units, are really where our bread and butter is, but we're happy to look at anything if you find something. As far as fees that we charge, it's 1% of the loan amount plus $8.95 total in processing and underwriting. Now you can negotiate, maybe the seller pays some of them's closing costs, but it's just part of the loan that, we do charge that. And then beyond that will be your typical cost of an appraisal, taxes, insurance, and title company costs.
And when you're calculating these properties and how they qualify, how does that work?
Yeah, basically we're looking at what the market rents are on the property, and we annualize that. As you can see in this example, we annualize the rents, we divide it by the expenses to come up with the net operating income. And then from there, we take that by your mortgage payment, and we're using what's called a debt service coverage ratio. And what that is income divided by expenses. So a 1.0 debt service is a break even. Anything greater than break even, obviously, is cash in your pocket. And we typically want to see about a 20 to 25% positive cash flow.
Absolutely. Okay, well, I really appreciate all this information. We put some of these fees up for you here so that as you go back and review this, you've got this information. Now, I've got another question from Kiki. Is there depreciation that is considered?
As far as depreciation that is considered, as far as tax-wise, the only time I have heard depreciation with non-recourse financing is really if a borrower is required to pay a certain type of tax, and it's called a UBIT tax, and I can send along a copy of our ebook that goes into that a little more, but then you can use depreciation against your IRA to make sure that you don't have to pay this specific tax. But other than that, you can't use the depreciation through your IRA property in your personal life or your personal taxes. Have to be through the IRA, and only if the IRA was going to be subject to that special tax.
Okay, perfect. Thank you so much for that information. Now, we kind of touched on all of this, but let's just go over it briefly, what documentation that you're going to need for that final loan approval.
Definitely. So if you have a property, we would ask that you fill out an eligibility form first. We'll be able to get a decision for you within a few hours. From there, if you decide to continue, the only things we'll really need are a copy of our loan application, your driver's license, IRA statements, purchase contract, and appraisal funds. If there's LLC documents, then we'll also gather those, but we try to make it as easy as possible so you don't have to give us a lot of information on that. And feel free to contact me. My number and information is at the end of this. I'd be happy to send you a copy of our ebook, which is Leverage Your IRA, and it'll go into the different benefits and how to actually do that. And then also, if you contact me, I'll send over the exact loan terms, the loan to values, the interest rates, the closing costs. We can run some scenarios. None of that costs anything, and I'll make it as simple as possible for you.
Fantastic. Jason, I really appreciate it so much. And we'll give all your contact information out. And then this class will be available on our link as usual within the next 24 hours.
Definitely. Well, thanks for having me, Leah, and great to be here.
Thank you so much. Everybody take care.